Welcome to Second Take, the show that takes a look at the issues behind the news. Finance Minister Enoch Godongwana delivered the medium-term budget policy statement today. Terence Creamer joins me to discuss some of the highlights. Hi, Terence.
Hi, Chanel.
Could you describe the tone of this medium-term budget policy statement following the difficulties in passing the budget earlier this year?
Yes, I think it represented a shift in tone from sort of crisis management and a muddled sort of a political setting as we entered the GNU era to one of quiet confidence. I think clearly procedurally they've tightened up and people are more on the same page than they were earlier this year when the sort of VAT hike blindsided some of the GNU partners and led to the budget being postponed a few times. And I think then on the other sort of confidence is coming, or the air of confidence is coming from the fact that they're starting to deliver on some of the things that they said they were going to do. You know, we've had this regular slippage every year on the fiscal front. And this year it seems like we're going to be able to hold the line in terms of peaking with our deficit, starting to bring debt under control. So that brings us sort of some level of confidence that things that were seen as quite difficult to achieve, and continually we had to change the sort of lines in the sand, we are now sort of able to hold the line. So I think that's also important. And then despite a weaker growth outlook for the year, 1.2% against 1.4%, we don't have any slippages, as I mentioned. And that's really because there's been an increase in revenue collection. Surprise on the upside. It was sort of signaled that there was going to be this better revenue collection, but it's come from, you know, higher consumer economy confidence, it seems, more spending, therefore more VAT returns, as well as some better tax takings from the corporates. And then obviously we've got this big compliance push where SARS has been getting more and more money and more resources to make sure that people are paying their fair share, and that also is contributing. So those sort of three levers are all coming through. And then I think also, you know, there was a lot of focus, don't hike tax only, you know, look at savings. And we're starting to see now under this targeted and responsible savings scheme, you know, rather than the old approach of just what they would call a lawnmower, where you just cut all budgets to sort of to bring the fiscal balances back in line. Here it's a much more targeted approach, and we're starting to see some of the figures coming through. So over the next 3 years, they're looking at initial savings of 6.7 billion, and that's really, you know, cracking down on grant fraud. About 3 billion of that's a grant fraud that they found, and then closing a public transport scheme that wasn't really delivering. And we should see some more coming through because there's a number of other programs under review at the moment that may be culled or may be rationalized in some way. And then the big one is the ghost workers, which also falls under this. They found almost 9,000 of these ghost workers through a data-driven approach. They haven't investigated these cases individually yet, but they can see the anomalies coming through, people getting double paychecks, or people that are not active in the civil service getting paychecks. So that sort of saving could also be significant. And then another part of the confidence boost, I would say, is it's all quiet on the SOE front, in the sense that there's no bailouts that can be spoken of, even though there are still companies in distress, Denel being one, the South African Post Office being another, but there's nothing to report on that front in terms of actual money from taxpayers going across to distressed SOEs. So I think it's this issue of emerging from crisis management into a more sort of not quite business as usual, but a more sort of confidence in their stride.
Lowering the inflation target was a standout development.
Yeah, this again was very well signaled, and I think there was no surprise when we heard today that the inflation target had been lowered to 3% from a band. We used to have a band of 3 to 6%, and it's now a point. But it has got on either side of that point sort of a release valve of 1 percentage point on either side to give the Reserve Bank governor some flexibility as he manages this inflation. And this was a vexed issue. No, not everyone was on board. Even the finance minister himself had some conflict with the Reserve Bank governor around this, having to assert at one stage that this is a policy that he dictates in consultation with the governor, not the other way around, because the governor's been quite strident on this point. But it's the meeting of the minds, and it's really following a lot of study, not only of modeling what it would mean for the South African economy, but also what it means relative to our peer group. And we were found to be somewhat out of line. One having a band that was quite wide and that having it fairly high. And then sort of doing the trade-offs. There are trade-offs there can be growth trade-offs. There's definitely fiscal trade-offs that are going to come through initially anyway. And saying whether the benefits of having this much sort of tighter focus on a handle on inflation is going to have, because obviously the instrument there is interest rates. And while we're in a sort of a falling inflationary environment, and therefore a number of interest rate cuts are forecast for the next few months, nevertheless, to maintain ourselves when there are shocks at a point like 3% can be difficult and can have growth and employment consequences. And in a country where we have a massive unemployment and we have a real growth problem, that is a big trade-off at times. So, but the balance, keeping money at a good value, taking almost inflation out of the equation as investors come in, as well as consumers buy, as we buy, having more certainty of our value of our money, is obviously a good thing in the long run. But it's not a costless exercise. So while it wasn't a surprise, it's been a major effort to get there because it has been highly contested.
There is a move to shift spending to support infrastructure.
Yes, I think again, from the sort of moving into quiet confidence, as I would term this budget, this is a big thing. This is where sort of the tire for me hits the road in this medium-term budget policy statement, because we get into some of the nitty-gritties about how we're going to start shifting the composition of our spending, which we know is very much around social grants and also around the wage bill, traditionally around consumption expenditure, and trying to shift this to more capital expenditure. It's always been on the agenda. It's been an aspiration set in the National Development Plan that we should have gross fixed capital formation at 30%. We've been tracking since the FIFA World Cup and then the subsequent, the global financial crisis and that big expenditure boom ahead of the FIFA World Cup. And then after the crisis, hoping to use it as a lever to get out of that, we never actually recovered. And it's actually tracking very low, well below half of that 30%, I think between 13 and 14%. So we also at below COVID levels. So we really need to be investing more. We can see it all around us, how much more we need to do around our roads, our water infrastructure. A lot of it is creaking at the moment. We went through a massive load shedding crisis recently, and infrastructure does have a massive multiplier effect. And I think in this medium-term budget policy statement, you get a sense that they're finding ways to start lifting capital investment again from the public infrastructure side. They're also looking at much more creatively at the financing side and how private sector participation, private sector finance and skills and ownership even can be crowded into this space. There's already a program, the BFR, where you have now 4 bid windows a year for those government departments and entities that are looking, and state-owned enterprises that are looking to do things with the private sector that need to deal with backlogs. And already, I think the big 2 that were announced around the iron ore line and the North Corridor, which is the coal line down to KwaZulu-Natal from Mpumalanga, but also the corridor between Durban and Gauteng. Those corridors need to be put back to work. and a lot of money has now been dedicated through the BFI channel. There's talk of a 15 billion minimum infrastructure bond to help raise money for infrastructure. There's talk of a dedicated fund line in the budget where we can see how much from departments and state-owned companies is going into infrastructure. So you can see there's a seriousness that's developed around infrastructure, which I think is important. We have massive backlogs, and we can see it. I mean, we're still seeing massive contraction in things like the construction sector in this last period, and we really do need. All of us need these services. We can see it also on the municipal front. There's some creative mechanisms, sort of pay for performance type schemes where grants can be accessed at the municipal level if they can perform, and also using the DFRs quite cleverly. Making milestone payments instead of going straight to a municipality, and then at the larger scale, the sort of Transnet and then the grid infrastructure, using DFI finance to set up the credit guarantee vehicle to help facilitate a big grid investment without recourse to the government guarantees, which has become a problem and it's stretched on the balance sheet. So really there's some much more detailed work rather than just saying we need more infrastructure. We're starting to see the detailed work and the frameworks that are needed to start turning this corner on the infrastructure spending side.
Thank you. That's the second Tech Show for this week. Thank you for watching, and join us again next time for more news analysis.